Welcome everybody. It's time for an update on the Story Fund. We're going to jump into this. I'm going to give an update on the performance of it. We benchmark this portfolio against the S&P 500. I show the returns whether it's doing good or bad. Whether we're trailing SPY or beating SPY, I'll show the returns either way. We do things a little bit differently on this channel, as you might know. First of all, we have a lot of transparency. I think it's good that there's a lot of financial YouTubers now that have more transparency than they did previously. And I'll say this of YouTube in general. The transparency is off the charts on YouTube when you're comparing it to the history of finance in general. Typically, finance is very hush-hush. People don't share that much information. You have professional money managers saying where to put your money, but they never show where they put theirs. So we do just the opposite on YouTube. I show where I'm putting my money. I don't tell you where to put yours. I just show you what I'm doing with mine. And not only am I showing you where I'm putting my money, but I'm also showing you the returns against the benchmark, the S&P 500. The reason that I choose the S&P 500 as a benchmark is because it is widely considered the long-standing representation of the entire US economy, basically the market. So when people talk about the market, they're talking about the S&P 500. Now, I call this portfolio my aggressive growth-centered portfolio. When I say a growth portfolio, that means revenue growth. That's what I'm talking about. If you're talking about a dividend portfolio, of course, you're talking about their dividend distributions, and typically that's a portfolio of companies that pay above average dividends. When I'm talking about this growth-centered portfolio here, I'm talking about their top line revenue growth. These are companies that grow their revenues on average much quicker than the average company. So while the S&P 500 might grow their revenues like, 8 to 10% per year, these companies, they might grow their revenues 20% per year, 30%, 40%, 50% year. That is a growth company if they're growing their revenues 50% per year, right? That is an aggressively growing company. They're not in the stage where they're trying to milk profits. They're not in the stage where they're trying to focus on their operating income, running a very profitable firm. They're in the stage of growth. That's what these companies are doing. So that is the portfolio. We're going to jump into a number of different holdings here, and I'm going to give just a quick overview looking back over the past week and over the past month. And just a friendly reminder, before we jump into that, you can always like the video. That helps out the YouTube algorithm, as well as you can consider subscribing if you haven't already done so. And if you want to bring your membership to the next level, I have to mention the Patreon, because if you join right now, you get free access for the remainder of the month, which of course is quite a while if you join right now. So join the Patreon, try it out. If you don't like it, you don't have to stick around. There's no risk with the Patreon. But having said that, let's go ahead and jump into this portfolio. Now, first of all, let me say the past month or so has been very good with the Story Fund. For instance, if I look at today I'm up 1%. That's above all three indexes, the Dow Jones, the S&P 500, and the QQQ. If we look at the past week, it was an okay week, but it was a better month. In the past month, I'm up 9%. That's pretty good. If I compare that, let's say, to the QQQ, the past week we're up 2.23%, so it beat me for the week, but then over the past month, I'm actually in the lead for the past 30 days. So even the aggressive QQQ, I beat out over the past month. So in recent over the most recent term, the past week and month, this has been going really well. All time since the beginning of this portfolio, I can look at the benchmark here against the S&P 500. This is what it looks like. The overall view of it, I would say that it's doing okay, not amazing. Right now, I'm ahead of the S&P 500. I was recently, just a month ago, a good decent amount below it, like 10% below it. So if my goal was with this portfolio to have low volatility, I would be failing at that goal incredibly bad. This is a volatile portfolio. The goal is not low volatility. The goal is at the end of a few years from now, right? At the end of 2005, let's say, I want to be ahead of SPY. And I want to be ahead of SPY by a decent margin. Not just barely eking by, but I want to actually beat it by a good amount. So there's no guarantees. I can't promise you that I can do that. There is unknowns in the world and things that we can't factor in, but I do think that I have a decent chance of beating it. And I think that a lot of people discredit their ability to pick stocks because most of the time, I think it's not as difficult as many people like to make it out to be. But as you can see, I was ahead of SPY for a while. That was in 2020 when all these type of growth stocks were going off like crazy. A lot of my smaller, more risky ones were doing really well. And then of course we had the major sell-off and it bounced down while the S&P 500 just rallied. And it rallied because of oil companies and because of these type of companies and industries that had been ignored for a while. So the S&P 500 rallied and it had sustained it throughout the year while my portfolio dipped back down. Now we're back where we're back ahead now. So right now my portfolio has a return of 19.76%. The S&P 500 has a return over the same time period of 16.8%. Not a convincing lead. Not enough to spike the football hair. I can't celebrate. I'm not doing that right now, but it is a lead nonetheless. I'll take what I can get so far. In terms of the portfolio, the past week and the past month have been really good. The gains have gone from almost being in the red to now having $15,600 in gains. And I've basically not done much. I've just held on to the companies that have sold off. When we had a big sell-off in companies like Netflix and Spotify, instead of panicking and selling out of them and second guessing my thesis on them, nothing had really materially changed. Netflix has slowed down with their subscribership growth, but I think that their slate of content at the end of this year and when people actually get back in their houses during the holiday season, I think Netflix will continue to grow. So I held on to these companies and they've mostly recovered. In fact, if I look at the actual companies that I'm invested in, I've picked out every one of these based off of different specific things that I like about them, but they follow a same trend. Many of them are subscription or residual based type of economic models. Many of them are in industries that I think are growing, not shrinking. Most of them are technology companies that have a high amount of scalability. They work with code. A lot of their products are digital. They can be copy and pasted, if you will. Those are the type of companies that I've focused on. So with that, I think I've had a good batting average so far. Out of the companies that I've invested in, most of them have been profitable, or at least most of the investments have gone up a decent amount. Some of them have gone down. With Snowflake, I invested $2,000 in. The jury's still out on this one. It will take a while till we see what's happened. It's down a little bit in the red right now. Pershing Square is one that's in the red a little bit. And then Teladoc has been one of my biggest losers right now. I bought that one right before it had a big sell-off, but I still think the company's growing and it's doing what it should. So I'm going to hold on to Teladoc. But overall, we can see the performance of this all time. If I filter by the past month, you can see the companies that have done really well. Over the past month, Apple has gone up over 10%. That's pretty amazing. There's a lot of things I think are going on with Apple. We have Adobe. This one has just been on fire. Adobe has been going up like crazy, 20% in the past month. PayPal has done well. Atlassian has done well. Spotify is up 11%. Twilio, this company is an absolute beast. It's up 18% in the past month. Then we have Doordash up 22% in the past 30 days. I was in the red on this one by a lot, by a huge portion, and now I'm basically level on it. I'm just right there, right between red and green. So I've earned back my losses on Doordash. We have Peloton up 12%, Shopify up 19%. Snowflake is a brand new holding. Square is up 9.7%. Teladoc's up 7.6%. So a lot of these companies that I was losing money on have rebounded a lot. And then even in big tech, Microsoft up 12%, Apple up 12%, Google up 6%, Amazon up 8%, and then Netflix up 7%, and Adobe up almost 20%. Just incredible numbers put out by these companies. If we look at some of the news here, we have this news from the streaming world. First of all, in the US, Disney has slowed down with their subscribership growth with Disney Plus. Netflix has slowed down as well. It seems like these streaming companies are taking a breather right now. They're not growing at the same pace that they were in 2020. This makes total sense. If you're looking at streaming companies, 2020 was very unique. It makes sense that they slowed down. People aren't stuck in home. In fact, they're thinking of doing the exact opposite. They want to get out at every opportunity. So I'm guessing this year, 2021, is going to be higher levels of churn for Netflix and Disney Plus and other streaming companies, and at least slower growth. I don't think their numbers will go down, but I think they'll have slower growth. Netflix actually did well in not having a ton of churn. It's about the same that they usually have. So at least they're not losing subscribers, but they're definitely growing slower. We have news that Lucifer, this is a Netflix TV series. This isn't one that I'm not interested in this one. I haven't watched it. I don't know anything about it, but apparently this one is very popular on Netflix. It reigns in streaming ratings, but free Raya makes a splash. So looking at the article, they say Netflix has Lucifer at the top of the streaming ratings, and it grew substantially in its second week of availability on the service. So for some reason, people like Lucifer. They like this show. The other one that fared well was Raya and the Last Dragon, had appeared on the top 10 during its few months of the Premier Access run, but on the week it became available for no extra charge to all Disney Plus subscribers, it vaulted to number 2 on the overall charts. So obviously Disney's milking the profits because these are huge, big budget films. They put them in the theaters first, and they calculated the exact amount of time where they get almost the majority that they can out of the movie theaters. They found that 98% of the money made in the box office is made within the first 45 days. So what did they put their window for release? Usually 45 days. Because it's just that nice balance between getting the most that you can get out of the box office, but also quickly going to the streaming services. That's what Disney's doing. And I think that they're looking at all the numbers. I think this is a decent strategy. Netflix, I enjoy that they're sticking to their roots of leaving everything out to streaming right away, even big blockbuster shows. So I think that they're both good strategies. I do like Netflix's a little bit more, how they're not trying to milk the movie in the movie theater first. But in my opinion, Disney should release them both simultaneously and do what HBO is doing right now. Moving on, we have the other stock, Adobe, that's just on fire. I don't have much to say about this one, and there's not a whole lot of news. My original thesis on Adobe has always been that the creator economy, the creation of podcasts, videos, animation, anything where you're doing like what I'm doing on YouTube, is exploding in growth. It's a huge industry and it's only growing. And the CEO realizes that. He says the company will blow it away thanks to the economic recovery led by North America. It's rare that you see a CEO use that terminology or anything that this is this enthusiastic, that they're going to blow it away. But he's being accurate. He's probably looking at the numbers and he knows this company is going to do well. And in every metric, Adobe has done well. It's up 20% in the last month. The stock has been way outperforming the general market, and I think it will continue to. Apple stock. This is what I want to mention with Apple stock. Apple is one that has a lot of disagreement right now. It's one of the top covered stocks. People like the company, but the big problem is, will they continue growing? It's that will they question. Will Apple continue to grow? I think that they will. The other question is that it's trillions of dollars we're dealing with. How much bigger can this company get? We have articles like this from Thomas Richards, somebody on Seeking Alpha, saying Apple, no returns ahead. Apple is one of the strongest companies in the market today, but at these prices, the stock offers 5% annual returns. Right now, it's up 7.4% since this article. So apparently it has its yearly returns in for this year and part of next year. In my opinion, I think that Thomas is incorrect in his assessment, but that's what investing is. We have disagreements. I think that Apple will have decent returns over the next couple of years. Thomas does not, and he's not alone in this. We have Dividend Sensei saying Apple not only is going to give you low returns, he's not just bearish on it like Thomas is, saying, the company's already big, it's going to give low returns. He's saying Apple is 68% overvalued. 68% overvalued. And then he highlights other companies that he thinks are better value. If Apple's 60, let's round it to 70% overvalued, what would that make Apple's PE ratio? Like 10, a PE of 9 or 10? Imagine if Apple traded down, nothing changed with its business. It's still doing what it's doing, gaining 40 million subscribers in 3 months. A company growing that rapidly, trading at a 10 PE ratio, cheaper than what AT&T is trading at. If that happened, I would be ecstatic. I would be buying as much Apple as I possibly could. I don't know what I would do at that point. If Apple traded down to a 10 PE ratio, if no big black swan event happened with their company, barring any crazy unpredictable event, that would make it one of the cheapest, best stocks, by far the cheapest and best stock in the market, by far. Right now, I think that Apple's undervalued. So the same thing though, you see a lot of disagreement with this company. There's some people bullish on it, many people very bearish on it, and they're openly stating their opinion. Time will tell. Returns will speak for themselves. I think in the next 2 years, I think I'll be on the right side of this debate. We have Doordash. This is one where if you think that Apple has disagreement, you have to bring it to a whole different level. Everybody seems to be bearish on Doordash than me. I am alone in this. I am the one investor, seemingly outside of people I don't know or don't really talk to, that's bullish on this company. There's some big funds and hedge funds that own it, even good names, right? I think Tiger Global owns it. They're a pretty good hedge fund. There's a couple others that own it that are aggressive hedge funds that they do their due diligence. They like speculating on companies like this. But DoorDash is a company that I'm bullish on. I like the company. But you look at the articles. Let me just take a peek here. The red means that the author of these articles are bearish. We have neutral, bearish, very bearish, neutral, bearish, bearish, very bearish, very bearish, bullish. We have one other person there bullish, very bearish. And these are the articles over like the past months at different price points. DoorDash has been all around different price points. These aren't really price sensitive articles. Many of them say that, but even when it drops 30%, they're still bearish on it. So overall, the summary is very bearish from at least Seeking Alpha and basically everyone else I talk to. Let me just say this about DoorDash. This company, my thesis on it is very simple. I can look at all the data. I can look at all the metrics and their growth and their revenue growth. The company's growing rapidly. They're taking market share. They gained 50% of the food delivery market share. I could go into detail on the company. In fact, I have in a specific episode about DoorDash. But there's one thing that I want to highlight with this company. At the end of the day, people have an app on their phone. They can go to the app. They can look at delicious food. They can hit one button and then it just magically pays for it with Apple Pay or Android Pay, whatever it is. And then in a half hour, they have delicious food on their doorstep. That's DoorDash. That's this company. That is something that's magical. 10 years ago, you could not have that ability to be able to hit a button and have food just appear to you without any interaction with anybody. So if you're one of those people that you don't like talking to other people, right? You're awkward or you don't want to socialize with other people to get your food, this is the best way. They just drop it off. You can tell them, just leave it at my doorstep. There is something, I think, that's meaningful in that. And it's more than just the company with all the metrics. When you break it down to what you're investing in a company that, I know this term is used so much, it's a little bit nauseating, but it's democratizing something. It's democratizing access to personal assistance. And I think that this is going to stay around. People like having personal assistants. Now there's other applications outside of just food delivery. You can have people pick up your dog food. You can have them go to the grocery store, to the convenience store, to the gas station, and get a number of items at all these different places. So DoorDash is one of these investments where I'm trying to just boil it down to whatever the most simplest form of it is. And I think the most simple form is an app that allows you to have a personal assistant. And I think that's going to be big. I don't know about fixing all the specific issues with this company. It faces many issues, but at the end of the day, hitting a button and having food appear, I think, is something people are going to want to continue. We have cybersecurity. This is news on CrowdStrike. This is another company I'm very bullish on. I'm bullish on the entire industry of cybersecurity. Obviously, this is the next big war that we're facing, is the war of code. Companies can be destroyed. Economies can be shut down. Real physical damage can be done with code. Physical damage, like making it so people don't have oil in their pipelines, right? That's physical damage being done. That's people's lives being affected. Cybersecurity is incredibly important. We're going to realize that over the next 10 years more than we do now. With CrowdStrike, I think they have the opportunity in their hands. If they can execute, they will own this market. But there's a lot of players that can be successful. This isn't a one company wins all. I don't believe that's the situation. The cybersecurity firm SentinelOne jumps 23% in its IPO debut. So this is a competitor to CrowdStrike, another company you can invest in. I would be bullish on all of them, but I'm counting on CrowdStrike. That's the one that I have my money in. Lastly, we have a company that is, again, one of these overvalued companies that makes people that haven't invested in it very frustrated. Because from the outside, it's the same thing like staying on the outside of Tesla. Why is it valued so highly? Why does it continue to be overvalued? If you're on the outside, you haven't had a position in it, you haven't been part of the gains, it can be frustrating to watch this company just go up further and further month after month and year after year. Now it has a market cap of like $185 billion. I heard people talk on Twitter saying Shopify is overvalued. It can't compound at $75 billion market cap. They literally said it's crazy. People are buying it. It's so overvalued. Why are they buying it? That was at $70 billion. Now the company's at $180 billion market cap, and they're doing some cool things. Shopify debuts its new online store, cuts commissions during the Unite 2021 event. So they cut their commissions substantially. One thing they did was they made it so that developers on their platform will not have to pay any commissions for the first 1 million they earn in revenue, and that resets every year. I think that Apple has done something similar, but they just lowered it. I think Apple should do the same. I think that Apple charges too much for their commissions. That's my conclusion that I've arrived to after pondering this issue for a long time. I think that this actually helps out Shopify. They're looking at the long term. If developers can have equity in what they're doing, and they can really own the projects that they're doing and not get their fees sucked away for at least the first million, it'll make it so that they're more loyal and they grow their apps and their platform on Shopify instead of a competitor. So I think Shopify is doing the right thing here. I actually think this is a situation where Shopify is ahead of Apple in their decision on lowering the pricing to 0% commissions for the first million and having that reset every year. I think that Apple should get on board with that. So that's some of the news that's happened over the past month with many of my holdings. I just want to highlight one more thing in this video. The total portfolio value is $95,600, and of that, $15,600 is from gains. So a smaller portion is from gains. It's a newer portfolio that I've built up rapidly through funding it. I don't want to continue funding it at this pace, so I'll continue to put money in it, but at a slower pace because I want the growth to mostly be from gains. I want this thing to grow by itself by picking out good stocks, and I firmly believe that will happen. It's easy to become discouraged in the world of investing. If you're discouraged from a pullback or bad news about a company, most of the time just hang in there. These companies are incredible. They're incredible. They have smart people running them. They have incredible opportunities. They're growing their revenues. They have sustainable business models. Out of the millions of companies in the world, these are ones that have made it to the IPO, to the public markets. They've gone through a lot just to get to this point, and typically they continue to compound. So if you pick out good companies, be patient with them. Just 1 month ago, my gains were $7,900. I could have been discouraged by this, underperforming the market or whatever, but I just held on to them. I didn't do anything. And then my gains literally doubled from 7,900 to 15,600, right? That's how quick things can change. In a 30-day period, my gains doubled. So keep investing, stay positive. If your story hasn't changed with the company in a material way, don't convince yourself the story has changed. If something minor has happened, don't believe that the whole story is over at the company, right? Pay attention to what's actually going on. Don't pay attention to all the noise. But that's my update. I hope you enjoyed it. You can check out the Patreon, like the video. That also helps. And I'll see you guys in the next one.